Welcome back to another episode of Multifamily AP 360. And today's our guest is Randy from InvestArk. Welcome back, Randy. You came episode 169. Thank you for coming back.
Rama, thank you so much. It's a pleasure to be back with your audience, and how the world has changed in about 2 years. So
we'll dive into that in a minute. So a little bit about Randy. Randy is founder and president of InvestArk Properties and general partner in 1,500 doors, representing 250 millions in assets under management. He has invested in a total of over 3,000 plus units in Texas, Oklahoma, Arizona, South Carolina, and LA. His investment strategy focuses on providing the passive investor significant returns by improving communities using a safe and time-tested approach. So with that, Randy, you want to add anything to your background?
no, not a whole lot other than, I guess, recent updates since we last talked. Is I have about a year ago, just about a year ago, I finally pulled the trigger and left the corporate world and doing multifamily real estate as a full-time job. And people say, you retired? And I say, no, I actually just redirected. I spending a lot of time still, but I'm doing what I love and what I enjoy. And that's a great satisfaction. I'm my own boss. And that's kind of what I wanted to do after a long corporate run and not having to answer to the man, as I call it.
Awesome. Thank you for that. And also congratulations.
Thank you.
So what makes you move full-time towards multifamily side, and also how exactly you planned that transition?
I would say what made me do it is just finally reaching this place in life where I felt comfortable. I've always coached and told people, don't leave until you can make near the money that you're already making. And so I would say that close to that. I'm not nowhere. Well, I shouldn't say I'm not making what I was making. I was an exec in corporate, so I'm not making what I was making. But at this season of my life, I don't need as much to live off of either. And so, but I had really been orchestrating that transition, Rama, for the last 9 years. I came to Houston. I live in Houston, Texas today, and I had been a passive investor primarily in single family flips. I was a hard money lender and found multifamily real estate. And once I fell in love with multifamily, I just dove in and educated myself and really set about that very conscious timetable of myself to step away from the corporate world and to make sure that I had people, processes, and income to support it. So yeah, it can be done. People can make a very healthy passive income stream.
Yeah, thank you very much. So from last talk to in between, so what have you done so far? How many multifamily you have invested? Did you face any challenges? Share me a little bit more about that.
Everything is just going wonderful. And I mean that tongue in cheek. It is going wonderful, but yeah, it is a business, as I tell people, and we all face challenges. So I think we last met in 21 sometime. And so I did 3 deals in 22. And like anybody that bought a deal in 2021 or 22, they bought it on variable rate debt. So I have 3 of those. One of them is knocking it out of the park as a home run. One is probably, one is definitely lagging, and the other one is to be determined yet. We're still in the process. So struggling with that variable rate debt and trying to overcome those obstacles. Interesting, the one that I'll say a solid double, if not a triple today in baseball terms, was the one I was the most worried about when we bought it, but is doing well. So the change in philosophy is, one, partnering with individuals in different markets that I don't have necessarily operational expertise. So I've partnered with people. I'm in Greenville, South Carolina. I'm in Tucson, Arizona, Houston, and Dallas today. So I did a couple deals in 22. I did 1 deal in 23 here in Houston. And as of today, 24, I'm looking at another deal. It's a build to rent community in North Dallas area with another set of partners. So on that, I guess the challenges are always there, but you have to keep moving forward and you can't become stagnant. You got to continue to move and evolve. And, I've seen some really good operators in the last year that have struggled with apartment buildings too because of the variable debt. So I don't think I'm alone in this challenge, put it that way.
Sure. So what kind of, measurements or what kind of, from operations files or anything else, how exactly you are managing, because of variable interest rates or cap rates,
Yeah.
Yeah.
Well, the two properties are kind of at opposite streams. They're both Class A properties also. One's a 396 unit in the Dallas market, and the other is a 60 unit in the Houston market. And I think what I'm sure you know, but really what it does is it forces you to focus on operations and making sure that you are maximizing every penny to increase that NOI. So whether it's increasing rents or decreasing expenses, excuse me, or increasing revenue, that's the good way it goes, is really the focus. So it really becomes operational focus. And then you need a little bit of luck because different kinds of lenders, we're finding one of the lenders on the smaller property is very formulaic, that it's just a checkbox. They're not going to give any grace. And then the other one seems to be on the larger property, seems to be much more willing to work with us and just navigate through the troubled waters. And so, but the one that where the smaller one where the lender is very stringent, that's the one that we're really making great progresses on the operations and turning it around. We had to really re-tenant almost the whole population of 60 units. And as you know, that's a challenge and a challenge on cash flow, et cetera. But we're through that side of it now. And so we're just continuing to focus on operations, is I think the short line, because that's the only thing we really can do.
Sure. Thank you for sharing that. Regarding that, 60 units completely turning over, right? So you're completely shifting like tenant base. So how long it is taking, like, how exactly you're achieving that? Because, shifting complete demographics, it's a bit challenging, right? So how exactly you're attracting different demographics?
In 23, early 23, like a lot of properties across the country, we were getting hit with a lot of delinquencies and a lot of evictions in that time period. I don't think we were alone again, but we were getting hit with a lot of them. And we changed property managers. We left the same company, but left same property manager. And you never really know a good property manager until you have a bad one. And so what a difference the person can make. And it's just night and day. And even though when we hired the first one, we thought we had a good one, time just, you do the best you can, but you also have to be willing to shift directions and pivot to a different direction. So we changed it. That is the single most ingredient. And this woman who's on the property today is just extreme. I mean, she talks to the tenants, and I've heard her talk about, this is your home, not this is your apartment, or this is, and she really emphasizes that. And she is very outgoing and meeting the tenants, whether it's in the parking lot or in the office or any place she can. So I attribute an awful lot of that change to just her, the on-site property manager.
Yeah, awesome. Finding, rockstar property management or manager is challenging. So how did you find, that kind of, property manager?
It was interesting. So 9 months into ownership, delinquencies, evictions, and the regional manager resigned, and we got a new regional manager assigned to us. And again, thought the first regional manager was good, but not until you found this woman who was just didn't take no for an answer to anything and was just a rock star. She went after it, and she found us the current property manager, a woman she had worked with before. And so, it's that leveraging the relationships that we as asset managers try to covet, and just simply leveraging relationships. And we first got the regional, though, because we thought that was the most important rather than necessarily on-site. And so this on-site current person was moving up. She was previously a leasing manager, which helped immensely too. She was a leasing person and wanted to move up to a property manager position. That's the short story.
Thank you for sharing that. So because of this, sudden interest rates or inflation or variable interest rates, is there any change in your approach in multifamily investing or your philosophy?
Yes.
How? Yeah.
Variable rate is obviously taboo today. And the deal we did in 23 was a fixed rate debt, and we're all hoping that the variables come down. But yeah, I wouldn't do any variable rate today. Fixed rate debt, you may pay more, but at least you know where your max is at. And if you've underwritten to that fixed rate debt, you're just going to be in a much better position. I think investors are almost requiring that today. I think investors have gotten savvy and don't want to deal with variable rate debt either, because they've either been involved in one or heard about another one being distributions being paused or whatever. So I think that's the biggest difference. Continue to focus on newer properties with less deferred maintenance. So we don't have deferred maintenance. That allows us to focus on operations again, leasing, maintenance, making the property look good, maximizing revenues. And I think that's the real current change, is avoiding the variable rate debt. And continuing for me, it's partnering with people, great people. So I've done a lot of joint ventures, co-GPs, whatever you want to call it. And I think that's the way I've been able to grow my business in the last couple of years since we last spoke. And I first wanted to do everything myself, find the property, underwrite it, find all the investors. And you just realize as a boutique or a smaller operator that that's not possible. You just can't sustain it in the long run. So that's been another mindset shift for me.
Sure. Awesome. Thank you. So what kind of terms you're getting for that, on the property you purchased in 2023?
I think it was high fives, this was a very large property portfolio here in Houston. It was 3 properties totaling 600 doors. So it was a big property, a big buy. And so it was able to get a fixed rate debt. I want to say 5, 6, 5, 7. And we got it on a 7-year term, 30-year amortization. That met our business plan, the 7 years versus the 10 years. That way you have yield maintenance costs, but they burn off much more rapidly because we're going to hold it. And the other really big thing about this purchase that we did last year in Houston, which some of your listeners would know if they're into Texas, is Texas is plagued with, we get reassessed from a tax purposes, real estate tax every year. And the reason I really signed on to this group that bought this 600 door property, 3 properties, is because it was tax abated. So we were fortunate enough to get Texas it's called the Public Facility Corporation, or PFC, piece of it, that the property was tax abated. So we paid no real estate taxes in exchange for a small affordability clause. But that is an instant $2 million savings a year. So that was the one that sold me. It doesn't have to be a rocket scientist to see if I stay status quo and take $2 million out of expenses, NOI is going to increase and be much more favorable.
Sure. Is that with the Lone Star Group?
That is, they're the lead partner on it. Yeah. Are you in that one too?
No, I'm not in that, but so yeah.
Yeah. It's a small world.
Yeah. Sure. So what is your process of finding, good partners?
My short answer to that would be is don't be in a hurry. I coach people and they want to have a coaching business. They want to, go really fast. Don't be in a hurry. Take the time to find people that you, just like an investor that like and trust. One of my mentors, Rod Khalif, said, partnerships are like a marriage. They're easy to get into and expensive and painful to get out of. And so you got to keep that in mind. And I would say I danced with people for a while before I ever joined it. So you mentioned Lone Star, the property here in Texas. They asked me to join them earlier in another property in Dallas. And I looked at the property and I just wasn't thrilled about it. It's doing fine today, I might add, but it just wasn't for me. It didn't fit my investment philosophy. And so I passed. And so don't be afraid to say no, I guess is what I'm saying to your audience too. You can get so deal hungry that you just fall in love with the chase versus the asset itself. And you've got other people's money in this. So you just need to really exercise your fiduciary responsibility.
Yeah. Discipline with, criteria, chasing deals, right? So
yeah.
Yeah. Thank you. That's very good advice. Thank you for sharing that. So now you're working on BTR property in like Texas, right, or Dallas market. Share me a little bit more about that, why you choose towards BTR side.
Well, development is something I've been wanting to do for a while, only because as this phase in the cycle, deals are getting tougher and tougher to find. And so I joined to my point, I've been asked to join in other deals that I have passed on just because they're the traditional value add or slightly value add. And there's nothing wrong with that. I still invest in those. But I was looking to, if I'm going to put my name on something to my investors, I wanted it to be kind of different. So in 23, it was the tax abatement project. In 24, it's this BTR project. And when you start to study BTR, build to rent, it just makes a lot of sense as we move more and more towards a nation of renters. And, in a BTR, you get a garage, you get a small backyard, I get a patio, and there's place for a dog to run or kids to play a little bit. And from my operations perspective, you tend to have people that are families that are going to be a different type of tenant, and they tend to stay longer. And they're probably not going to leave for 25 or $50 increase like some in an apartment building would be. So I just really like it, and I'm in the age of life where give me about another 5 to 10 years, I'll probably be looking to join one of those communities myself and get rid of the house just because I don't like the maintenance. People can't afford a house as easily as they used to. I have millennial children, great incomes, but they can't afford the down payment. And daddy's not going to give it to them. So
Yeah, got it. So when exactly it will be ready or available for residents?
actually, the offering is coming out probably in the next week or two. The property itself, we're in horizontal right now. So we're putting in streets, utilities, et cetera. That is scheduled to be completed end of Q3, early Q4 this year. So I would anticipate in October, November's timeframe, we start putting in foundations for the vertical build of the units. And that's scheduled to take through the end of 26, so 25 and 26 to lease up, to build 118 townhomes, to build them and lease them up, planned for the end of 26. And then from an investment perspective, you can, we hope to refinance the construction loan and give investors back a bunch of money and hold it for another couple of years. But I'm excited about it. And when you get to North Dallas, I forget, where are you, Rama?
I'm out of Greensboro, North
Greensboro.
Carolina.
A
Yeah,
lovely
North,
part of the country.
yeah, North Dallas is a growing great market, right? So
Yeah. I mean, it's in North Dallas, and it's in a city called Melissa, which I didn't know where it was.
yeah,
And so I had to drive up there and spent a long time up there looking at all the comps and everything else. And it's just amazing. It's a smaller city today, but the population, it's right next to McKinney, if anybody knows where McKinney, Texas is at.
yeah,
And it's a small population today, but there's something like 50,000 people plan to move in that vicinity in the next 10 years. And it's just, even for a Texan like me, it's crazy. There was not a building that I saw that was older than 5 years old. I mean, everything. So they build a brand new high school, like less than a mile away from the asset that we're going to build. And they built a $35 million football field. The houses around this area are all 600K plus. So it's just got really good demographics. And so what better place to be in a place with great school systems, renting in a BTR with homes like that and the caliber of real estate. So
sure. Yeah, thank you. So any challenges with lending, for especially ground up developments or BTRs?
yeah, not yet, because we've raised a bunch of equity so far. And the equity we've raised is going for the horizontal development. We're using that to fund horizontal. And then once we start the vertical, as I said, later this year, that's when we'll take out the construction loan, hoping the market improves a little bit before then, but we're positioned to do it right now either way. And we can take out a loan even at a higher rate, but prefer to not be. And as you know, as construction loan, you're only paying interest only and it's only for the assets the money you've drawn down. So it starts out small and ramps up towards the end.
Thank you. So what's your plan for next 2 to 3 years?
Well, I mentioned a colleague and I have started a multifamily mentoring group and hoping to grow that in the next 12 to 24 months. We have our first 3 enrollees, and we're looking to continue to grow that. And then on the other side, I'm going to take on a little individual project of my own to build a couple of duplexes here in the Houston area. That's on my agenda. And I'm also, I don't know if you have one, but I'm also reviewing the fund of funds model, which I'm attracted to recently. I know that tends to be but rather than having multi-projects and getting investors for every one, why not just have one fund which investors can share in? So I'm not there yet, but it makes a lot of sense to me.
Yeah, sure, absolutely. And any habits that are helping you to be successful?
I would say the only habits I would count to is it's really easy to be downtrodden, especially 21, 22. But I would say just be in it for the long haul, be encouraged. It's a marathon, it's not a race. For those that are out there new getting started, and invest in your education, because wherever I still get educated, you and I go to seminars and masterminds and stuff like that because there's still something to learn. And I'm always kind of amazed that people that spent tens of hundreds of thousands of dollars on their academic education, but don't want to spend a little money on multifamily education. So continue to educate yourself, be persistent, stay in the game. I think it's about the long haul. So
Yeah, awesome. Thank you. So any recent learning that impacted you?
well, variable rate debt has kept me up at night for a while. That's the biggest one. And then I think there's nothing else that really learning lessons as Rod Khleif says to me, because we all have them, right? And if you are an investor and you talk to somebody that says they haven't had any, I think that's a red flag, because there've always been challenges. But the variable rate debt has been the biggest one that sticks out in my mind.
Good. Any recent books that impacted your life?
I think the one that I've been reading I like the best is The Clash of Cultures. It doesn't do with real estate a lot, but The Clash of Cultures by John Bogle, who is the former CEO at Vanguard Investments. And he talks a lot about investing versus speculation. And that really resonates with me because we as multifamily investors in real estate always look at the upside, but investing is really understanding the total risk of the project and managing it, versus speculation is when I just throw $50,000 at Rama or Randy and put it in this investment. Because you and I want investors that are intelligent and understand the risk, and there's no surprises if things do go south. So that's really resonated with me, the difference between investing and speculation.
Got it. Thank you. And how can listeners connect with you, Randy?
It's really been a pleasure, Rama, to be on your show again. And so I would say the easiest way is my webpage is invest-ark.com. There's a contact me on there. And then the other thing I wanted to just offer your listening audience today, as I mentioned, I'm starting a mentoring group. So we want to, for your listeners, if they contact me at Randy@multifamilymaestros.com, Randy@multifamily.maestros.com. We're going to offer them a small entrance fee for $197 for 3 months just to trial it. So happy to do that as well. And I really thank you for your time today.
Awesome. And thank you very much, Randy. Thank you for sharing, current challenges. I mean, last 2 3 years challenges, and also how you are moving towards BTR space, and also thank you for sharing your personal habits that are impacting you.
Have a great day. It's been enjoyable.
Thank you.